Most people dream of paying off their home and getting that financial freedom, that security from doing so. I even thought so. Yet, here's the shocking truth. Paying off your mortgage could actually cost you years of your freedom. And in fact, it might even be the very thing that prevents you from ever getting that financial freedom that you so desire. And that's the thing I wanted to address today is what's the safe advice that could actually be the most dangerous advice of all? And what could be better? That's what we'll talk about right now. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. This show is for you, especially if you want your money to work harder for you so you don't have to work so hard for that money. You want to become work optional, where you have enough passive income to work because you want to, not because you have to. But you're not just doing it to get rich, although that's a great benefit, but you want to do it to live a rich life because as you're blessed financially, as you have more resources, you now have a greater capacity to bless the lives of those around you. I appreciate you guys tuning in, binging, sharing, all the things you guys have been doing to make this great. And big announcement here today, guys. Guess what? Our book, Work Optional Blueprint, is coming out in September. So be sure that if you're not following us at moneyripples.com, if you're not on our email list, be sure to follow us because we'll have a launch party where you can actually get that book for free. So be sure to do that right now. Okay, so let's just talk about paying off your house, right? We've talked about debt and how debt is not necessarily evil. It depends on what kind of steward you are. But what about the house? Right? I mean, how many times have we been taught that the dream has always been be debt free and of course to stuff in so much money that you can live on less than the interest, right? That's always been what's taught to us. In fact, when I was a financial advisor, I taught it. And as a mortgage broker, I taught it there as well. I was always teaching people how to pay off their house early because that's what the mortgage companies taught me to do. I'll tell you why they taught me to tell you to do that. So there's all these things I've been taught. But then I remember sitting down with my own father. Now, remember, I talked to him. I sat down with him. He had paid off his house in 18 years. He was totally debt free, stuffed money in his 401k. Yet I had to tell him, Dad, you only have about 5 or 6 years worth of money before you have to go back to work or die. Right. And that was not what he wanted to hear. Now, I always skip to, what do I do, Chris? And I always say, I don't know. Well, that was the eventual discussion. But initially, I started figuring out, what are we going to do? Do we take your 401k money? Do we take some other money and put it into like annuities or whatnot? I was like, well, a lot of it's locked up because it's stuck in that company 401k. You can't get to it unless you quit or get fired. Don't do that. And so I said, well, the only other asset you have is your house. You have a paid off house. He said, oh, well, should I not have it paid off? I said, well, and again, I remember I was of the belief you should pay it off. I said, well, I mean, the only thing you could do is try to either sell it, which I know you don't want to do because you want to stay in your home. So the other option is to do a cash out refinance. And yeah, I can help you do that. I'm a mortgage broker. But we have to make sure it's invested in some place that's safe and is going to earn better returns than your 6% mortgage that you would get. And he's like, well, where is that? Where can I do it? Now, remember, he was so debt adverse, but he was getting desperate at this point. And I said, I don't know. I mean, you could try to put into this indexed annuity, whatever, where there's some guarantees, but what if it doesn't perform well enough? By the way, good thing I didn't do that, or even a variable annuity where it's in the stock market, because 2 years later, the Great Recession started happening, right? So that wasn't good. But I was like, I don't know, because I can't guarantee you'll get high enough return to even make it worthwhile to pull out the equity. And that's where it left us. And that was a kind of a rough situation to be in. Now, I also, in my own situation, I thought paying off your house would be better too. Even when I was of the mindset, even after I became financially independent when I was 28, I eventually bought a brand new home, bought one that was big enough to grow our family into. It was going to be our forever home. It was my dream location. I loved it, right? It was even a show home, right? So this was not a cheap home either. And so, of course, I was thinking like, okay, this is what I'm going to do. I'm going to not just pay down this equity, because I can always pay it down because I'm a mortgage broker. I can always get the cash back out if I need it, but pay down my home because Dave Ramsey taught me to. And then of course, I'm even going to finish the basement and add more value and equity in it by adding more bedrooms and bathrooms. And so I did. And I felt like a genius because by the time we got done with all the renovations, guess what? It appreciated by more than what I even paid. So I have 150,000 equity in this house. But then of course, things get tight with launching that new business I had with Garrett Gunderson, right? And so things were getting tighter. I cut off some streams of income. And so it's like, what do? I started burning through my savings because I did have an emergency fund. I wasn't like all living in debt. I had an emergency fund. I was burning through that. And then after I was starting to run out of money, then I started going into my credit cards and things like that. But I figured, ooh, I better not do that. Maybe I don't have to sell my house. So maybe I do a cash out refi. So before I was starting to really tap into the credit cards, I go to the bank. I said, hey, I've got plenty of equity in this house. Can I get access to it? And they said, sorry, starting of really end of summer of 2007, we stopped giving out cash out refinances. Sorry. And that was it. I'm stuck with all this equity in this house. I can't get a cash out refinance. So of course I started using credit cards and whatnot to help float. But we get into 2008 and I'm like, what am I going to do? Like I don't have any other options. And so I thought maybe I have to sell my house. I didn't want to, but maybe I have to sell it. But by that point, because other people, because the credit markets get tight, whenever we run into recessions, banks don't like to lend money. So the credit market got tighter. And as a result, our real estate values dropped. And so mine dropped even below my mortgage balance. And they said, well, you're going to have to short sell at this point, meaning you sell it for less than what you owe on the mortgage, but you have to get the bank's permission to sell it. So we did. And eventually we found a buyer to buy it. It was actually about a little less than 100,000 less than what I owed. Got the buyer all lined up, and the bank said no. They said, nope, we don't want to do that. We don't want to sell. We don't want to short sell. So of course, 2009, the next year, I lost my house, right? I foreclosed on it. They sold it for now 170,000 less than the offer they had just the year prior for that short sale. Of course, it was owned by Lehman Brothers, which is why I got a $300 settlement check for bad mortgage practices from that mortgage company for not doing those kind of things and helping us get out of the mortgage. But I mean, that's the thing. I learned pretty quickly, just because you have equity in a home, even if you have a paid off house, doesn't mean you're financially free. The only way you're going to be financially free is if you have enough passive income coming in to cover everything. And so what's your alternative, right? Now, I'm not opposed to paying off a mortgage in the sense that, all things being equal, if you have plenty of passive income coming in and you got money just burning a hole in your pocket, sure, pay off the mortgage. I've told clients to do that. I said, listen, you've got the money to do it. You're not going to do anything else with it. You're not going to invest this other money too. Why not pay it off? It'll free up the cash flow. You can do that. But even in that case, some of those clients are like, nah, never mind. I think I can do better, make more money outside of my mortgage. But it's always an option. And I'm not saying you don't pay your mortgage payments. I actually love a 30-year fixed mortgage, especially if you can get a low rate. I love it. But I just don't agree with paying off extra to that loan. And here's why. We talk about get lean, get liquid, and get out, don't we? Well, obviously part of getting liquid is getting that money in your possession. And remember, I said that the mortgage companies taught me to tell you to pay off your mortgage early. Why would they do that? I'm going to show you why right now. All right, so here's an example. Say you have a $400,000 mortgage. You have it 6.5% for 30 years, right? That mortgage payment is going to be $25,28. Now, as a mortgage broker, what I used to show people, I used to convince them they need to pay it off early because I would show them this number. How many total payments are you making? That 2,500 times 360 months, that's 30 years. You're going to be paying $910,000. That means $510,000 this goes to interest. You're now paying more than double the mortgage balance of $400,000, aren't you? Because now you're paying $510,000 of interest. So I'd show people this. I said, if you want to stick it back to the bank, what you're going to do is pay this sucker off early. You're going to pay extra principal to it. You're going to pay it down. Biweekly payments, I actually realized pretty quickly, biweekly payments don't work where they have you pay it every 2 weeks. That's basically just an extra 13-month mortgage payment, a 13th month. You'd be better off just paying that in the beginning of the year, paying a 13th month, and you'll pay it off faster than paying it every 2 weeks, just so you know. But I show them this. I'm like, man, look at that. That's horrible. Pay it off early. Pay extra to it because you'll free up money. I'd say, hey, look at this. Say that you pay an extra $500 a month. That's basically 20 years paying it off. Look what happens. You free up almost $200,000 of interest by doing it that way. Now, what I didn't mention is, of course, you're paying the extra $500 a month, right? So now there's extra cash flow coming out to do that. But I would show them that. And so that's the thing. Here's what's crazy. Isn't it interesting that mortgage companies incentivize you to pay off your mortgage early? And remember, we talked about debt before and that whole fallacy with that. But think about this. If mortgage companies wanted you to keep this mortgage forever, wouldn't they try to incentivize you with a lower interest for a longer time? Now, someone might argue and saying, well, of course, Chris, it's higher risk to make them pay longer. But is it? Because really the highest risk is having a massive mortgage payment that you can't afford. Really, if you had a lower mortgage payment because you stretch it out over more years versus 15 years or 10 years, that's higher risk. I've actually, by the way, had clients that had perfect credit get denied mortgages when they try to pay off in 10 years because the payment was too high compared to their income. It was too risky. So they said, no, you can do a 20-year or a 30-year payment, but that's it. Right. So again, the banks, it's not always about the just simple interest that you think it is. It's not just about that. But of course, why do they incentivize us? Why do they offer a lower interest rate saying, hey, 6.5% for 30 years, but I'll give you 5.75 if you pay it off in 15 years? Why would they incentivize you to pay off earlier? The reason is this: fractional reserve banking. For every extra dollar you pay in principal, they can now loan out $10. So think of it this way. Think that for every dollar you had, your friends and family say, I'll throw in another, $9 or $10 on top of it for you to invest. Would you do it? Now, as long as you knew the investment was good, you'd say, of course, right? Yeah, because not only would you pay them interest, you might say, hey, I'll pay you 1% less and I'll take the extra 1% spread. And now I'm making money off of it, right? So now you're making extra money off of their money because you're making a spread off the interest and you have more leverage power to be able to bring in more interest too. So think of it that way. Like, I mean, let's have you do the math. Say you had $10,000 and as a result, just to make easy math here, your friends and family throw in another $90,000. Now, normally your 10,000, say it's going to earn 10% a year. Yeah, you'll make $1,000 a year off that 10,000. But if you had $100,000 now, and say that you even told them like, listen, I'm going to pay you guys 8%. They're like, yes. And you're like, thank you. Because now the extra $90,000, I'm earning an extra 2% a year on. So now I'm making an extra, say, $1,800 off of their money for free. And I'm still making my 10,000. So now I'm making almost $12,000 off that money. I'm now creating more leverage, right? So remember, you've got your 10,000, you're like earning your whopping $1,000 a year, but now you have 100,000. Now the 100,000 is now earning $10,000 a year if it's making 10%, right? So you're making 10 times. Now, granted, if you agree with your friends and family saying, I'll pay you 8% a year, they're thinking, yes, 8%, that's what I wanted. So now you're taking the spread. You think, oh, it's only 2%. Think again, that's 2% on the $90,000, right? So now you're earning an extra $1,800 on top of it. So what's really happening here is, yes, you're still getting paid your $1,000. So now what happens, you went from $1,000 to now making $2,800. You made almost triple the money because you had that leverage. I know that might have seemed like a lot of math. It would probably be easier to illustrate it for you, right? That you're saying, hey, my 10,000 still made $1,000 a year, but because of the spread I made from making more money than it cost me to borrow that money, which by the way, this is what people do. This is what banks do when they put your money in the savings. They're paying you interest while they make more off that interest, don't they? Way more than that little spread. But what happens is, of course, it's not like a 2% gain because of that leverage. What ends up happening is you're like, wait a minute, I just made now 2,800 from my 10,000. I made 28% instead of 10%. I made almost triple the money because I was able to make the spread off of it. I was able to make that 2% off of their $90,000, which is an extra $1,800. This is what banks do every single day. They take your money in savings as their debt, quote unquote. But then that money that's in savings, again, you give them 10,000, they can loan out 100,000. They're saying, great, thank you. I just made money off your money and I didn't have to put any of my own money in, right? If you've been following this podcast, you're probably looking for great ways to create passive income right now, right? Well, we got you covered here with Central Lending. Central Lending specializes in alternative investments that actually are designed to create steady returns and long-term financial security for you and your family. Now, they prioritize transparency. They love, building those strong relationships, giving you that confidence and peace of mind, knowing that you have your money working harder for you, so you don't have to work so hard for that money. You want to learn more how to do that? Go to centrallending.com and check out what they've got today to create your passive income and wealth creation right now. So when you pay extra payments on your mortgage, when you pay extra principal on it, guess what? That allows them to be able to leverage more money faster. It's just like if your employer came to you, or if you're a business owner, you're the employer, but all of a sudden they said, hey, instead of paying you over the next 10 years, I'm going to pay you over just 2 years. So if you're going to pay $100,000 a year for 10 years, that's $1 million. I'm just going to pay you $500,000 a year for the next 2 years. Would you want that? Yeah, it's speed, it's acceleration, velocity of money. You can take all that extra money, you can actually start investing it now, create more passive income now versus waiting out a slow process over 10 years. You can just make so much money faster. This is what banks do. They don't accumulate wealth, they accelerate it. They use velocity of money. This is what I'm talking about here, because here's what happens. Yes, it does cost you the $510,000, but what if? What if you had other assets you'd be selling off and doing things that maybe you had just barely enough to scrimp $400,000 to pay off this mortgage free and clear? Because your best case scenario is pay it off today. Because paying that little extra dibbly, few $100 a month or whatever on that really doesn't move the needle that much, especially over 30 years. So what if you had the money pay off today, but you didn't? You put into like say a 4% CD. What would that look like? Well, let's take a look. Okay, so $400,000, like I said, you had that cash that you could use to pay off the house today, because the best case scenario is freeing up that $510,000 interest right now. That's your best case scenario. But instead, you took that $400,000 and put into a cruddy little CD, earning 4% for the next 30 years. Now that's 2.5% worse than your mortgage payment. Remember that mortgage interest was 6.5%, and you were paying $510,000 over the life of that loan, that 30 years. The question is, how much will you make with really just over half that interest rate, making 4% instead of 6.5%? How much do you actually earn? Let me get rid of the inflation. Here we go. Now we take out the total ending balance principal, because the $400,000 we take out just like we did from the mortgage. But look, your total interest is almost $900,000. This is almost $400,000 more than that mortgage at 6.5%. How is it possible that a 4% interest rate on your money can actually outdo by almost double a 6.5% mortgage? Any of you guys have been following me long enough, especially if you have an infinite banking policy, know the answer. Because I learned the same concept, by the way, about 2008, 2009 with infinite banking as a strategy. How could you have a higher interest loan rate on your money that you borrow from the insurance company or from a bank and still out earn the money based on the money they're paying you? Is because they're not the same interest rate. When you pay on a mortgage, it's simple interest. You ever seen that as you pay on a loan, more and more goes to principal, less and less to interest? That's not because the banks are screwing you. Just so you know, it's very simple math. When you pay even $1 more than interest, right? And I mean like an interest only payment on your mortgage. If you pay even $1 more, you're paying that mortgage balance down a little bit. That means the interest you're being charged, that percentage they charge on that money is on that balance, it goes down just a little bit. So even if you pay an extra, $10,000 on your mortgage, say it was 400,000, now you're down to 390,000. Now you're only being charged 6.5% on the 390,000. Your payment has been the same, right? You've been keeping the payment the same. So what happens is that just over time, because you pay the balance down, less and less gets charged to interest because the balance shrinks, more and more goes to principal. But the opposite happens with interest, right? When it comes to compounding interest. When you put your money into savings, it's compounding. For example, look here, 4%, right? On 400,000, it's 16,000 that year you made. But look, the next year, because you had 416,000, you now make 4% on that, you make 16,640. Year after that, 17,305. Pretty soon you're up to 20,000 by year 7. Pretty soon after that, you're about 30,000 by year 17. And that's over about 40,000 by year 24. And then it's about 50,000 by year 30. It just keeps compounding because the balance grows. So you see this little hockey stick effect, right? As you see here in this little graph, where it's the opposite because the interest you're being charged goes like this as time goes on, right? Or if you just see it another way, interest is being charged like this. And yeah, it goes like this, but then it starts to cap off. It starts to slow down the amount of interest they charge you. This is why compounding interest works. Just so you know, the secret formula here is on a mortgage, a 30-year mortgage, you have to earn just a little less than half. So if I were to put in, say I'll put in 3%, watch this, you'll come up pretty close. You still beat it. 3% earning on 400,000 over 30 years is 570,000. You still beat it by about over $60,000. What if you earn the same interest rate, that's 6.5%, but you compound that over time? Watch. $2.245 million. That means you walk with about an extra $1.7 million plus net profit above and beyond the interest you paid on that mortgage over those 30 years. Do you think that might be worth it? Would that be a good investment? Especially when it's hardly even negligible at that point. What if you earned 8%? Now it's 3.625. You make 3.1 million more. 10%. Now you're at 6.5 million. You make $6 million more than the 510,000. If I can make 6.5 million, heck, if you can make 6.5 million from just 500,000, would you do it? Yes, that's a great investment, right? That's the difference. This is why I have a 2.75% mortgage and I don't pay anything extra to it. Now I'm paying my minimum payment, my principal and interest payment, but I'm not paying extra to it. I want that money freed up because if I can use that money to make money now, just like the bank does, I'm making more money. Understand the banks literally bank off of your ignorance. The banks bank off of you, literally. They're loving when you pay extra into your savings and let it sit there and you set it and forget it. They love it when you pay extra principal on your mortgage. You think you're smart. They think you're dumb because they know they're making the money way more than you do. You just get to save a teeny bit of little interest when you just try to pay extra on your loans and your mortgage. They're making millions of dollars off of you because of it. That is the difference. This is how paying off your house could literally be costing you millions of dollars by trying to pay it off early when you could be using that money instead to make more money for you, especially over the next few decades. The wealthy already get this. The wealthy already doing it. This is why, like even Apple, for so many years, especially about the time that Steve Jobs died and Tim Cook started to take over, they had so much cash on hand and they had debt. They had more than enough cash to pay off the debt, but they didn't because they knew they could make more with it. And as I just showed you here, you don't even have to earn the same interest rate to be able to pay it off. That's the benefit. That's the cool thing about this is that you can actually make so much more money just like the bank does off of you, but we turn the tables, flip the script and put it back in your favor versus theirs. This is why they taught me as a mortgage broker to teach you how to pay off early. But what I learned instead was as an investor and a wise steward of my money, if I can be a wise steward of my money and I can invest in the right places, I could literally make hundreds of thousands, if not millions of dollars off of them. This is the difference. This is why paying off your mortgage early could cost you and sacrifice all of your financial freedom. This is why you actually want to be more careful with it. You don't want to have to pay it off. And if it did work, I'll tell you this, I wouldn't have so many people worth $2-3 million net worth coming to us and saying, I've saved, I'm debt free, including my house, and yet I can't retire. I don't have financial freedom. I'm asset rich, cash poor. My dad was in that same situation. Many of our clients have been in that same situation. And what do? We start looking to see if we use the equity or not. Do we sell off assets? I had one client that we sold off an investment property because he's only making $200 a month. Even if he became mortgage debt free, which was his goal, he would have $2,400 of cash flow coming from his investment property. But by selling his property, pulling out that $700,000 of equity, investing it elsewhere, he's able to make $6,000 a month from day one. And then on top of that, as he started to reinvest that $6,000 a month, doing it faster, again, like a bank, started doing that faster. Now at this point where he would have about had his mortgage paid off at this point and at the end of 2025, he now has over $100,000 a year of passive income coming in. Not $2,400 a month, but over $100,000 a year coming in because he was able to create leverage faster. That's the difference. Equity, just like net worth is worthless unless it can actually generate passive income for you. Again, I'm not opposed to paying off a house. I actually intend to do it myself at some point, but I'm going to leverage it as much as I can in the meantime while it makes sense. Many of you have mortgages less than 4% a year and you get tax write-offs on it. You actually get to write off the interest on your freaking taxes. Why would you want to pay that thing off any faster? You would want to say, no, I want every dollar available for me to make money now, to create my freedom right now versus delaying it forever, only to find out it just won't be enough. That's what you're going to do. That's what's going to be your future because I've seen it time and time and time again. And I don't want that to happen to you. And so if you want to take back the control of your freedom, you want to make sure that you're doing the right strategy. Should you pay off your house? Like I said, in some rare cases, it makes perfect sense. But in many cases, it may not. Should you do a cash out refinance? Sometimes, maybe it makes sense. Maybe you should sell the house. What's the best strategy for you? It just depends on your situation, right? Again, if you have questions on this, you want to know how you can maximize that, feel free to reach out to us at moneyripples.com. But the point is this, is that being even a mortgage debt free, having a home equity and just having a paid off house is not the freedom you think it might be. The truth is you still have expenses. You still got to pay for the expenses. Just because you have one less little mortgage payment does not mean you have financial freedom. You need passive income to go with that. And by the way, if you actually invest your money right, you could actually create enough wealth with your money to then pay off your house early anyways, if you chose to do it. Although once you learn how to make that money and that wealth, you may not want to pay it off with that extra wealth. But it is possible to pay off your house earlier than just paying extra payments by getting your money working harder for you right now, creating that passive income for you right now and growing your wealth the way it should be so that you can take full advantage of the bank's money just like they take advantage of you. That's how you do it. That's how you become a wise steward. Again, go to moneyripples.com if you want to learn more. Make it a wonderful and prosperous week. See you later.